I'm looking at the most divided Federal Reserve decision in 6 years. And what happened on December 10th should terrify every American taxpayer. This wasn't just another routine interest rate cut. This was a 9-3 vote that exposed fundamental cracks in the Fed's ability to manage the economy. And the implications for your financial future are staggering. Here's what the headlines missed. While everyone focused on the quarter-point rate cut, I'm analyzing the unprecedented internal warfare that's ripping apart the Federal Reserve. 3 Fed members openly dissented, something that hasn't happened since September 2019. But this wasn't ordinary disagreement. This was a complete breakdown of consensus on the most critical economic decisions facing America. Fed Governor Stephen Miron voted for a half-point cut minus double what was approved. Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeffrey Schmid wanted no cuts at all. Think about that for a moment. The people supposedly managing our monetary policy can't even agree whether we need aggressive stimulus or complete restraint. And you're the one who pays the price for their confusion. Chair Jerome Powell called it a close call and admitted he could make a case for either side. This is the person responsible for managing $28 trillion in economic output, and he's essentially telling us he's guessing. But here's what really concerns me. This internal division is happening at precisely the moment when clear, decisive leadership is most critical. The government shutdown created a 44-day blackout in economic data. The Fed was literally making decisions without current information about inflation, unemployment, or economic growth. Powell compared it to driving in the fog. But this isn't a casual Sunday drive. This is monetary policy that determines whether millions of Americans keep their jobs, whether families can afford their mortgages, whether retirees can maintain their purchasing power. Let me walk you through what this decision really means for ordinary taxpayers. The Fed cut rates at 3.75%, but their own projections show only one more cut in all of 2026. That means borrowing costs will remain elevated for the foreseeable future. Your mortgage rates, credit card rates, business loans, they're all staying high while the economy shows clear signs of weakness. But here's the deeper problem that nobody's discussing. The Fed is trapped in an impossible situation, and their internal division proves they have no clear path forward. Inflation remains at 2.8%, well above their 2% target. But unemployment is rising toward 4.4%. Job gains are slowing, and businesses are implementing widespread hiring freezes. They need to fight inflation with higher rates while simultaneously supporting employment with lower rates. It's mathematically impossible. The 3 dissenting votes tell the entire story. Moran, who was appointed by Trump just months ago, wanted aggressive rate cuts to prevent labor market deterioration. He's clearly positioning for the more dovish policy that will come when the new Fed chairman takes over in May 2026. Goolsbee and Schmid represent the inflation hawks who believe the Fed has already cut too much and risks reigniting price pressures. This isn't just academic disagreement. This represents fundamentally different views about what's happening to the American economy. The hawks see tariff-induced inflation, strong consumer spending, and tight labor markets requiring continued restraint. The doves see slowing job growth, business uncertainty, and economic softening requiring aggressive support. But here's what's particularly disturbing about the timing. Powell's term expires in May 2026, just 5 months away. President Trump will appoint the new Fed chairman, and based on his previous statements and Moran's dissenting votes, that person will likely pursue much more aggressive easing. The current Fed knows their policies are temporary, making decisive action even more difficult. The economic data they're working with is fundamentally compromised. The October jobs report was delayed by the government shutdown. November inflation data arrived too late to influence their decision. They're literally flying blind at the most critical juncture for monetary policy in years. I've been analyzing the Fed's latest economic projections, and they reveal just how uncertain their own outlook has become. They raised GDP growth projections for 2026 from 1.8% to 2.3%, a significant upgrade, but they also expect inflation to remain above target until 2028. They're essentially betting on a productivity miracle that allows faster growth without additional price pressures. The labor market data tells a different story. Job cuts announced in October surged 175% compared to the previous year. Over 450 companies announced plans for further layoffs, the highest level since the pandemic. Unemployment claims remain low, but that's a lagging indicator. The leading indicators all point towards significant labor market deterioration ahead. Yet the Fed cut rates by only 0.25% despite clear evidence of economic weakening. Why? because they're terrified of reigniting inflation. Powell explicitly mentioned tariffs as causing most of the inflation overshoot. But he also said tariffs create only a one-time price increase, which contradicts economic reality. Sustained tariffs create sustained inflationary pressure, especially when combined with immigration restrictions that reduce labor supply. The Fed's credibility problem is becoming acute. Markets have lost confidence in their forward guidance because internal divisions make consistent messaging impossible. The dot plot projects only one rate cut in 2026, but nobody believes that's credible given the changing leadership and economic deterioration. Here's what this means for different types of taxpayers. If you're carrying variable rate debt, you're facing continued high borrowing costs with limited relief ahead. If you're a saver, you might benefit from elevated rates in the short term, but those benefits will disappear when the new Fed leadership arrives and cuts aggressively. Homebuyers face a particularly challenging environment. Mortgage rates have declined slightly following the Fed's decision, but they remain near 6.2%, well above the 3-4% range that prevailed for most of the past decade. The Fed's inability to provide clear forward guidance means mortgage rates could swing dramatically based on political rather than economic factors. Small business owners are caught in the worst possible situation. They're facing elevated borrowing costs, just as demand softens, and labor costs remain high due to immigration restrictions. The Fed's mixed signals make long-term planning nearly impossible, forcing businesses into defensive mode precisely when economic growth needs business investment and hiring. The international implications are equally troubling. Foreign investors are losing confidence in U.S. monetary policy credibility. When the world's reserve currency is managed by a central bank that can't reach internal consensus, it raises fundamental questions about dollar stability and American economic leadership. But there's a more fundamental issue that the Fed's division exposes. Monetary policy has become increasingly politicized, with Fed members taking positions that align more with political preferences than economic data. Moran's consistent votes for larger rate cuts clearly reflect the Trump administration's preferences rather than independent analysis. The transition to new Fed leadership in May creates additional uncertainty that markets are only beginning to price in. The new chairman will likely bring a completely different approach to monetary policy, potentially reversing years of careful inflation fighting. This policy whiplash could create severe economic disruption at precisely the wrong moment. Looking ahead to 2026, I see several troubling scenarios developing. If the economy continues softening and the new Fed leadership cuts rates aggressively, we could see renewed inflation alongside rising unemployment, the dreaded stagflation scenario. If they maintain restrictive policy to fight inflation, we risk pushing the economy into outright recession. The Fed's own projections suggest they expect inflation to remain elevated through 2027 despite their commitment to the 2% target. That means either their policies will fail to control prices, or they'll need to implement much more aggressive tightening that would severely damage employment and growth. For ordinary Americans, this division within the Fed represents a fundamental breakdown in economic management. You're facing continued high borrowing costs, uncertain employment prospects, and persistent inflation, all while the people responsible for fixing these problems can't even agree on basic diagnosis, let alone treatment. The most concerning aspect is how this Fed division reflects broader institutional breakdown in American economic policy. When monetary policymakers can't reach consensus on fundamental questions, when government shutdowns prevent basic data collection, when political appointees vote along partisan lines rather than economic evidence, these are signs of a system under severe stress. My advice for taxpayers is to prepare for continued volatility and uncertainty. The Fed's inability to provide coherent forward guidance means financial markets will remain choppy, interest rates will be unpredictable, and economic policy will be driven more by politics than analysis. Build financial resilience, maintain flexible debt structures, and don't rely on Fed policy to solve fundamental economic problems. The specific voting breakdown reveals deeper ideological conflicts within the Fed that go beyond simple hawk-dove distinctions. Moran's consistent advocacy for larger cuts represents a fundamentally different approach to central banking, one that prioritizes employment support over inflation control. His appointment came directly from the Trump White House, making his votes inherently political rather than purely economic. Goolsbee and Schmidt's opposition to any cuts reflects growing concern that the Fed has already compromised its inflation credibility. They see the current 2.8% inflation rate, persistent housing cost pressures, and potential tariff impacts as requiring continued monetary restraint. Their dissent represents institutional memory of how quickly inflation can accelerate once central bank credibility is lost. Powell's position in the middle reflects his attempt to balance these competing pressures while managing the transition to new leadership. But his admission that he could make a case for either side reveals the fundamental uncertainty plaguing monetary policy. When the Fed chairman can't articulate a clear rationale for policy decisions, it signals institutional confusion at the highest levels. The data blackout created by the government shutdown compounds these problems by forcing the Fed to make critical decisions without current information. The October jobs report showed job gains slowing to their weakest pace in months, but that data arrived weeks late due to furloughed government workers. November inflation readings were unavailable entirely, leaving the Fed to guess about recent price trends. This information vacuum couldn't have come at a worse time. The Fed is trying to navigate between rising unemployment and persistent inflation while major policy changes from tariffs and immigration restrictions work their way through the economy. Making monetary policy without current data is like performing surgery while blindfolded. The consequences of mistakes become magnified. The business sector is responding with increased caution. Corporate hiring freezes have become widespread. Capital investment decisions are being delayed, and businesses are building larger cash reserves rather than deploying capital productively. Consumer behavior reflects similar uncertainty. Household spending remains resilient among high-income groups, but middle-income families are reducing discretionary purchases. Credit card delinquencies are rising, suggesting elevated borrowing costs are straining family budgets. The housing market provides a particularly clear example of how Fed uncertainty translates into real-world consequences. Mortgage rates remain volatile, swinging based on Fed communications rather than underlying economic fundamentals. Potential homebuyers are paralyzed by uncertainty about future rate direction. Regional Fed presidents' dissents also reflect geographic differences in economic conditions. Goolsbee represents manufacturing-heavy regions that benefit from reshoring but suffer from tariff-induced input costs. Schmidt oversees agricultural areas facing trade policy uncertainty. These regional perspectives highlight how Fed policy affects different areas differently. Agricultural states worry about export markets. Manufacturing regions face tariff-induced cost pressures. Service sector metros deal with labor shortages from immigration restrictions. The timing of the leadership transition adds complexity. Powell's lame duck status reduces his leadership ability during a critical period. Fed officials know their current framework will likely be reversed under new leadership. Market participants are already positioning for the May leadership change by discounting current Fed guidance. Interest rate futures price in more aggressive easing than the Fed projects, reflecting expectations that new leadership will prioritize growth over inflation. International observers are watching this Fed transition with growing concern. The obvious political nature of recent appointments signals a concerning erosion of central bank independence that has been a cornerstone of U.S. economic credibility. The December 10th decision wasn't just divided, it was revealing. It showed a Federal Reserve institution struggling with unprecedented challenges while facing internal political pressures that undermined their independence and credibility. The cost of this institutional failure will ultimately be paid by ordinary American taxpayers through higher borrowing costs, economic instability, and diminished confidence in the institutions supposed to protect their financial well-being. The quantitative tightening program's end on December 1st adds another contradiction. While the Fed cut rates by 0.25%, they simultaneously announced $40 billion monthly in Treasury purchases starting December 12th. They want to appear tough on inflation through limited rate cuts while supporting markets through asset purchases. The corporate debt maturity wall approaching in 2026 makes Fed policy uncertainty particularly dangerous. Approximately $1 trillion in corporate debt will require refinancing at much higher rates. Companies can't plan optimal timing when central bank policy remains unclear. The municipal bond market faces similar challenges. State and local governments that issued debt during the pandemic at low rates now need to refinance at higher rates while facing reduced federal transfers. Healthcare costs represent another area where Fed uncertainty creates planning difficulties. Hospital systems carry substantial debt that becomes expensive when rates rise. The education sector faces comparable challenges. Universities that borrowed heavily during low rates now face higher servicing costs. Pension funds are particularly vulnerable to Fed policy uncertainty. These institutions need stable environments to meet obligations to retirees. Fed policy confusion creates volatility that threatens retirement security for millions. Insurance companies face similar challenges from interest rate uncertainty. Life insurers need to match long-term liabilities with investments, but Fed uncertainty makes this difficult. The credit card and consumer lending markets reflect Fed uncertainty through increased volatility. Banks are reluctant to offer fixed-rate products when they can't predict future funding costs, pushing more consumer debt into variable-rate products. Small business lending has become challenging in this uncertain environment. Community banks face difficulty pricing loans when they can't predict future rates. This isn't just about interest rates. It's about whether America's economic institutions can function effectively in an era of political polarization and policy uncertainty. The Fed's divided decision suggests they cannot, and that should worry every American taxpayer about what comes next.